Good day, Junior Techies. I'm Mrs. Brimacombe. We are going to look now at a combined activity. This is typically what you can expect in a test or an exam. You are presented with financial information of Gadgets Limited for the year ended 28 February 2022. Gadget Limited sells gadgets and specializes in drones at a markup of 80% at cost. Stock is imported from America. The economic recession has negatively affected sales as many people are cutting down on luxury items. Gadgets Limited is registered with an authorized share capital of 4 million ordinary shares. Always read the information before you start the activity. It's important to take note of the markup percentage that was given to you and that they've got an authorized share capital of 4 million ordinary shares. And now they've also provided you with information about the economic recession that has negatively affected the sales. So what is required? We are going to look at each one of those questions individually. They provided us with financial indicators and with the additional information. It is important to take note. They provided you information on the share capital. A reminder, you will be provided with a formula sheet, but it's in your best interest to make sure that you study your financial indicators. Because when you need to analyze and comment, that formula sheet doesn't tell you how to comment or which financial indicators to use with which questions. So make sure that you study it. If we now look at question 1, they've asked us to comment on the profitability. So you need to know which financial indicators to use when we're looking at profitability. Our options: gross profit on cost of sales, gross profit on sales, operating expenses on sales, operating profit on sales. So when we're commenting, a reminder, we have to compare last year's figures with this year. Quote figures, indicate the trend, and then provide an opinion. So if we look at the gross profit on sales, what happened with it? Gross profit on sales increased from 40% in 2021 to 42% in 2022. The gross profit on cost of sales, what happened with it? There was an increase from 62% to 75%. Always remember, when we're looking at the gross profit on cost of sales, we're looking at, have we achieved our aimed markup or not? So in the information provided to you right in the beginning, they said to you the markup was 80% on cost. So now we need to bring this into our answer by saying what? Although there was an improvement, we have still not achieved our aimed markup percentage. An improvement can indicate that there was less trade discount given to customers. Always look at also other possible reasons, because sometimes they can say to you, apart from trade discount, what other reasons could there be for an improvement? If we look at our operating expenses on sales, it increased from 28% to 37%. This indicates that it was not well controlled. Looking at the operating profit on sales, what happened with it? It decreased from 20% to 15% in 2022. Commenting now on the liquidity, we've got 6 options. But you need to look at the information given. You can't just randomly name financial indicators. use the information provided. So if we look at the information provided, we've got current ratio, asset test ratio, rate of stock turnover, stock holding period, and the debtors collection period. We've also got the average creditors payment period. But now you need to look at what does the question say exactly. The directors are satisfied with the improvement in the current ratio and the asset test ratio. Explain why you would disagree with them. Quote 2 financial indicators in your response. So this is not just simply writing any of those liquidity financial indicators. Be careful in how these questions are asked. So if we look at the stock holding period, what happened to the stock holding period? It means how long do we keep our stock? It increased from 52 days to 90 days, which means that we're keeping our stock for longer. The stock turnover rate dropped from 7 times per year to 4.1 times. So again, we're keeping our stock for longer and it's taking us longer to sell our stock. When we're looking at the current ratio and the asset test ratio, we can see that there's an over-investment in stock. How do we calculate that? How do we know that? If you take 2021 and you take 1.2 minus 0.5, that equals 0.721. That is what my inventory is equal to. If you look at 2021, the difference between the two is 1.4. That represents my inventory. And this is why we could use the current ratio and the asset test ratio in this question. If we look at the type of business that we've got, the problem is gadgets and drones. This can become obsolete due to advancement in technology. The debtors collections period, if we now look at debtors collection, what happened? It increased from 35 days to 48 days in 2022. It means that we are taking longer to collect money from our debtors, and this could create a potential cash flow problem. When we compare the debtors collection with the average creditors payment period, we do collect money from our customers before we pay our suppliers. So that is not a potential problem for the business. Question 3, dividends. Comment on the dividends per share over the 2 years and quote figures. So if we look at dividends per share, what happened? It dropped from 103.6 cents to 72.2 cents. It means that we've paid out less in dividends. We can also mention by how much it dropped, so the difference between the two, and then we can also calculate the percentage. So to calculate the percentage, you take the difference divided by the amount in 2021 times 100. Percentage is always out of 100. Explain the change in the dividend payout rate and give a reason for this change. So when we're looking at the dividend payout rate, it means that we're looking at how much funds did we retain of our earnings and how much did we pay out in dividends. So this is a calculation that you need to do first. How do we calculate this? If we look at 2021, we take the dividends per share divided by the earnings per share. Percentage means we need to times it by 100. When we look at 2022, we take the dividends per share divided by the earnings per share. So if we're looking at the dividend payout rate and we compare last year with this year, there was an increase from 70% to 95%. Do not get confused now. Yes, the dividends per share dropped from last year to this year. But if we're looking at the dividend payout rate, there was actually an increase in the percentage. Directors attempted to please the shareholders for the low profitability. If you look at your earnings per share, you can see that the earnings per share dropped by a lot. The company has only retained 5% of the earnings for future growth. Or it's not only future growth. The company can decide not to pay out dividends for various reasons. So if I look at 100 minus 95, that equals the 5% which was retained. A shareholder felt that they should be satisfied with the dividends they received, as it's better than last year. Explain why you would agree with him. So when we're looking at answering this question, always remember to quote figures. But now, what figures am I supposed to use? We look at the earnings per share. So the earnings per share dropped from 148 cents to 76 cents. So you can use percentage as well. Calculate the percentage by how much. But the dividends per share also dropped from 103.6 cents to 72.2 cents. Now, if we take those figures and we now work it out as a percentage on the market price, look how it changes the picture. In 2022, we take the dividends divided by the market price. In 2021, we're going to do exactly the same. We take our dividends per share divided by the market price. So now if I compare the two percentages, there's an increase from 15.9% to 17.6%. This means that the dividends per share as a percentage on the market price increased. Question 4. Comment on the risk and gearing for both years. Quote 2 financial indicators with figures. So when we're looking at the risk and gearing, we always look at the return on total capital employed and the debt equity ratio. Looking at our debt equity ratio, it increased from 0.4 to 1 to 0.5 to 1. So quote the figures indicate if there's an increase or decrease. The company has a low to moderate financial risk. We are still more reliant on own capital than borrowed capital. The return on total capital employed, what happened with it? It decreased from 30% to 24.2%. But now this is always compared to the interest rates on loan to see if we are positively geared or negatively geared. So when we compare the return on total capital employed, it still exceeds the interest on loan of 17%. This is why the company is positively geared. Something that the company needs to be aware of, if the return on total capital employed continuously dropped and the interest rates increase, the company will suffer financially and should consider paying off the loan. Question 5. Existing shareholders are dissatisfied that the new shares issued on the 1st of March 2021 were sold to the CEO, Boston Buller. Boston Bulls owned 47% of the shares on 28 February 2021. How did this affect the percentage shareholding in the company? So if we're looking at the number of shares. If we've got on 28 February 2.5 million shares in issue, I'm going to step number 1, subtract the 500,000 additional shares that was issued to find out what was the number of shares in issue before that. Why? I want to know what was the number of shares that Boston owed. So then we take the 1,750,000 before the additional shares were issued, and we times that by 47%. Now we can calculate if he purchased the additional 500,000 shares. This is the total number of shares he now has in the company. So to find out now the percentage that he owns, we take the number of shares divided by the number of shares in issue. So again, we take his number of shares divided by the total number of shares in issue. That equals 52.9%. This means that he now became the majority shareholders. So now they're asking, give reasons why you would consider their feelings to be justified, and quote figures. So looking at, he is the CEO, so he's getting preferential treatment. He purchased the shares for R2.50. How do I know this? The sale of shares we've received, that was an inflow of cash, 1,250,000. So if we divide that by 500,000, that means that the total repurchase or purchase price was R2.50. There's lack of transparency. This is against the Company Act. Shares must be advertised. The market price, this is another thing that we can look at. The market price is R4.10 and the net asset value is R3.10. So he purchased it for less than what the shares are actually worth or what the company could have gotten if they decided to sell it on the JSE. If we take the market price and we times that by 500,000 shares, our potential earnings could have been much higher. We could have gotten 2,050,000. Instead, we got 1,250,000. Thank you very much. In our last activity, we're also going to look at a combined activity, looking at all the financial indicators. But then we're looking at how do we compare one company with another. I want to leave you with this quote: your future is created by what you do today and not tomorrow. Have a wonderful day.